In the mid-1990s, economies across East and Southeast Asia were growing at an astonishing 8 to 12% a year. Hundreds of millions of people were lifted out of poverty as cities expanded into dense centers of construction and export-led growth. To maintain this relentless growth, these countries needed foreign capital. Governments in Thailand, Indonesia, and South Korea offered global investors a strict guarantee. They tightly pegged their local currencies to the US dollar, removing currency risk for anyone willing to lend them money. This flowchart maps out the specific structural flaw that made the boom so fragile. Local banks borrowed cheap, short-term US dollars from foreign lenders. They then turned around and lent that money out domestically, in local currency, for long-term bets like commercial real estate and stock market investments. This engine relies on foreign lenders continuously rolling over those short-term dollar loans. If they stop, local banks are suddenly starved for dollars they don't have, leaving their long-term domestic assets completely stranded. That exact scenario played out in the spring of 1997. Thailand's surging property bubble burst, taking down the country's largest finance company. Foreign lenders panicked and immediately stopped renewing their dollar loans to Thai businesses. The Bank of Thailand quietly burned through $33 billion of its own foreign reserves, trying to maintain the illusion of the peg. It wasn't enough. By July 2nd, with the vault practically empty, they were forced to let the baht float. The currency immediately went into freefall. By trying to engineer a perfectly predictable environment for foreign investors, Thailand had quietly built a severe currency and maturity mismatch. Once the peg broke, the entire system collapsed. With Thailand's economy unraveling, foreign lenders frantically looked at neighboring countries and saw the exact same warning signs: fixed exchange rates, huge short-term dollar debts, and weak bank oversight. Investors rushed to pull their capital out of the entire region simultaneously. The sudden withdrawal of foreign money created the exact liquidity crisis the markets were afraid of, turning a latent vulnerability into a self-fulfilling panic. The deepest economic collapse hit Indonesia. Following the abandonment of its exchange rate band, the rupiah lost over 80% of its value against the dollar. The drop instantly bankrupted local conglomerates, and layered on top of severe food shortages, the economic pain quickly boiled over into mass riots. The ensuing chaos completely destroyed the political authority of President Suharto. By May 1998, he resigned, ending a 32-year grip on power. Meanwhile, South Korea faced its own severe crisis. The country's chaebols, the giant, family-controlled industrial conglomerates, had financed their rapid expansion with enormous short-term dollar debts. As foreign capital fled the region, several of these corporations defaulted. Countries with distinctly different domestic economies, from Thailand's property markets to Korea's industrial conglomerates, were swept into a singular crisis. Shared investor perception alone was enough to transmit an economic collapse across borders. Between August and December 1997, the International Monetary Fund, alongside other global lenders, assembled coordinated rescue packages totaling roughly $117 billion for Thailand, Indonesia, and South Korea. But this emergency funding came with rigid conditions. Borrowers were required to aggressively raise interest rates, slash government spending, and close insolvent domestic banks. Prominent economists heavily criticized the approach, arguing the IMF was treating the wrong disease. Because this was a private sector debt crisis, not a case of government overspending, critics warned that forcing strict fiscal austerity during a severe recession drove viable companies into bankruptcy and worsened regional poverty. By 1998, the shockwaves escaped Asia. The sudden regional collapse severely damaged global investor confidence in emerging markets as a whole. That sudden capital flight, combined with plummeting global oil prices, fractured the Russian economy. In August 1998, Russia abruptly devalued the ruble and defaulted on its domestic debt. The Russian default triggered a severe flight to safety, shifting global markets in ways quantitative models had not predicted. This unexpected shock pushed long-term capital management, a highly leveraged U.S. hedge fund run by Nobel laureates, to the brink of collapse. Fearing that a disorderly failure of the fund could destabilize the entire global financial system, the Federal Reserve Bank of New York stepped in to organize a $3.6 billion private sector bailout. In just 14 months, a localized currency devaluation in Bangkok traveled through foreign exchange markets, sovereign debt, and leveraged hedge funds, eventually arriving right at the doors of Wall Street. The affected economies eventually stabilized, with South Korea and Thailand returning to positive GDP growth by 1999. But the trauma of running out of dollars dictated a new approach to how Asian governments manage financial risk. As this chart illustrates, starting in 1998, Asian central banks began aggressively hoarding foreign currency. This steep, exponential upward curve represents an act of sovereign self-insurance, built specifically so these nations would never again be forced to negotiate an emergency rescue package with the IMF. And when we break down the composition of these assets, we find that nations like China and South Korea funneled these expanding Asian reserves directly into U.S. Treasury securities, making them some of the largest holders of American debt in the world. Governments also moved away from rigid dollar pegs, adopting more flexible exchange rates. They established regional currency swap networks, like the Chiang Mai Initiative, to ensure emergency liquidity could be accessed outside of the IMF's control. The crisis of 1997 proved that a nation doesn't need reckless government spending to trigger an economic collapse. Excessive private borrowing, combined with perfectly synchronized global capital flows, can quietly build up enough pressure to threaten the architecture of the entire global economy.